Many seemingly cheap stocks are cheap for a reason. They are poorly run businesses, often going from bad to worse. But every so often, the market falsely misprices a generally great business, and those are often the best investing opportunities. That's why today I'm showing you four stocks that fall into that much more attractive, deep value category. If that sounds like something you'd want more of, then go ahead and hit that like button. It's the single best way to tell YouTube to send you more videos like this in the future. Let's get right into it. The first stock today is ACCO Brands with the symbol of ACCO. On the surface, this might seem like the most boring company you have ever heard of, but things start to look a heck of a lot more interesting when you appreciate the big picture. Now, before I go a little deeper, I need to remind you this is not investing advice. I'm presenting real data and stocks, but any investing decisions are yours and yours alone. So always do your own due diligence. And by the way, I'm Steve Reitmeister. All my friends call me Righty. I've been investing for over 40 years and currently a partner at WallStreetZen.com, where I help build a quant rating system that analyzes thousands of data points to figure out which stocks have the best shot at beating the market. All the stocks today shine in the light of this quant ratings model. Now, let's get back to ACCO. Whether you realize it or not, this company probably takes up prime real estate on your desktop and in your office drawers. That's because they make essential things like notebooks, binders, staplers, laminators, and shredders, right? All the office essentials. Yes, I hear you yawning. Let's get to the part that really counts. The company also makes computer docking stations and gaming controllers. This is the much faster growing tech side of the business that the management team is leaning into heavily, and it's starting to show up in the improved earnings outlook. The problem is the market is still focused on that sleepy office supply side of the business. The result is an ultra low PE of only 4.5 when the average stock trades for about 20. That, my friends, is the deep value opportunity at play in these shares. And here's a pleasant bonus. How about a greater than 7% dividend yield to go on top of that value story? ACCO pays out only about 37% of its earnings to fund that dividend. That's pretty low and has good odds of increasing in the future, especially given their above average earnings expectations. Now, let's put ACCO under the microscope of our Zen Ratings Quant mod. Remember that all in all, we review every stock by 115 different factors and boil it down into an intuitive letter grade, A through F. Note that A-rated stocks have historically outperformed the market by nearly 3 to 1. Now, underneath that overall rating, we drill down to 7 different component grades that help explain the unique strengths and weaknesses of every stock. ACCO comes in with an overall Zen rating of 8. That amounts to a strong buy recommendation, which is well deserved because it scores in the top 3% of all 4,600 stocks analyzed for its stellar fundamental profile, right? So the component grades tell a compelling story as well. First off, the AI grade lands in the top 10% of all stocks tracked. Now, to be clear, that is not about how much artificial intelligence this company is into. Rather, this grade is based upon our own proprietary AI model, spotting the kind of price and data patterns that have historically come before a stock starts to run much higher. Now, sentiment is even better. In the top 3%, that tells you the smart money is taking notice of these shares. And the standout grade, here again, we're talking about value. Yes, value sits in the top 1% of all stocks tracked. I already shared with you the ultra low PE of 4.5, but this value grade is actually based on a review of 21 different value factors. So yeah, value indeed. The risk here is that ACCO carries a good chunk of debt, and that shows up in their middle of the pack C rating for financials, but no stock is perfect. Here we get a company reinvention story that is really starting to unfold, and yet the market is still asleep. Add to that the stellar fundamental profile as proven by the Zen Ratings analysis, and how about that 7% dividend yield is a nice cherry on top. Now, that's not a bad way to start our deep value focused video today. Now, before we get on to the next stock, just a quick heads up that if you want to discover even more attractive stock setups, then the best thing you can do is sign up for my next live training session this coming Monday. The focus is on timely market insights plus my top picks. Now, it's totally free, but you do need to sign up. So do that now to join me this coming Monday at 7 p.m. Eastern Time. Just go to wallstreetzen.com/live. All right, now let's move on to a stock that most investors have left for dead. Talking about Pitney Bowes with a symbol PBI. Now, many of you will not recognize the name at all, but the few who do will say, oh yeah, that's that old postage meter company. And that view explains the value proposition. But today, Pitney Bowes has transformed into a well-rounded shipping logistics company. In fact, they run one of the largest mail sorting operations in the country, a growing parcel and e-commerce shipping arm, and a financial services segment on top. Shares have rallied over the past 3 months, highlighting that investors are finally waking up and smelling that value. Now, gladly, there are still plenty of reasons to believe we are in the early stages of a long-term turnaround that points to much, much more upside ahead. Now, one reason to believe this turnaround has legs is the expected earnings growth of about 30% a year, more than twice the pace of the average company these days. Another reason to believe in the continued share price upside is the ultra-low valuation. This shows up in spades with a PEG ratio of only 0.64. Now, remember, the average PEG ratio for any stock is 1.5, so that means PBI shares are severely undervalued relative to that growth, right? The Zen Ratings agrees with this bullish view on Pitney Bowes, where they score an overall rating of A, which is equivalent to a strong buy recommendation. Note that we give A ratings to the top 5% of all stocks after that full 115-factor fundamental review. In this case, PBI is actually in the top 1%. Rarefied air indeed. Now let's focus on those component. Financials comes in strong, top 18% all stocks. Momentum is right there with it in the top 16%. And once again, the standout grade is value. Here we're talking about the top 1% of all stocks reviewed. But the toughest thing with value is often about timeliness. That is solved by seeing that the momentum grade is in the top 16% of all stocks. The honest risk here is the same with any company in turnaround mode, that being the need to keep proving out the improvement with each quarterly earnings report. If they can do that, then these deep value shares should greatly outperform as this phoenix continues to rise from the ashes. And since we are talking about value, if you're getting value out of this stock review, then hit subscribe and turn on the notification bell. That's because I publish data-driven stock analysis like this often, and it's the best way to ensure that you see the next videos as I release them. The next company fell into penny stock territory under $1 a share. Then investors realized the mistake, leading to a massive rally for shares in the past year. But here's the surprise. Even now, some folks on Wall Street see another 130% more upside in the year ahead. The stock I'm talking about is Ironwood Pharmaceuticals with a symbol of IRWD, yet another deep value opportunity. Ironwood is a healthcare company built around the gut. Their main product is a blockbuster treatment for gastrointestinal conditions, and it throws off serious cash. This is not some clinical stage science project hoping for approval someday. It's a real profitable business selling a real product right now. The profitability here is striking. Ironwood runs an operating margin near 57%. Now, that kind of profit margin is what you would expect from a software company, not from one in the pharma industry. And its earnings are forecast to grow at nearly 31% a year going forward, well ahead of its industry peers. Now, on top of that, we have a rock bottom PEG ratio of 0.23. That is literally 85% lower than the average stock. Shockingly undervalued for this much growth unfolding. Now, on the Wall Street side of things, coverage is thin as you would expect for a smaller company. We have just one analyst with a buy recommendation, but it's worth noting that their price target implies upside potential of more than 130% in the coming year. Now, analyst recommendations are updated daily, so be sure to add Ironwood to your free watch list on WallStreetZen.com to get updates on the analyst activity on this stock or any other. And heck, the Zen ratings are updated on a daily basis as well, so make sure to set up your free watch list now. Okay, as you have come to expect in this video, we are dealing with another stock with a Zen rating of A. In this case, A+ might be more accurate, as they score in the top 1% of all stocks tracked based upon its impressive fundamental profile. Now, this shows up loud and clear in the review of their component grades. We have momentum in the top 17% of all stocks. Growth is even better at the top 5%. By the way, that's the most telling of future earnings beats ahead. Financials are better still at the top 2%, and now coming down the home stretch, value is in the top 1% of all stocks tracked. Now, 4 strong component grades stacked together like this is unusual but very attractive. It tells you the stock is cheap, it's growing, it's financially sound, and it's a timely stock as well. Right now, the main concern is all about the debt the company took on. Gladly, management is paying it down aggressively, cutting it towards a fraction of where it once was. Every dollar of debt they retire is a dollar of value that shifts back to shareholders. That's one of the driving forces of this investment as more growth unfolds. Investors are finally bidding shares back up as they see the dark cloud of debt starting to blow away. What remains is a profitable and growing firm that is downright dirt cheap. That 130% upside potential noted from the Wall Street analysts may prove to be on the light side as this story continues to unfold. That brings us to the last stock, and I think you'll see why I saved it for last. But first, an important reminder, if you want to stay one step ahead of the market, then join me live every Monday at 7 p.m. Eastern Time. That is when I share my updated market outlook and trading plan to outperform. It's also when I share my trade of the week based upon the Zen Ratings quant model and my greater than 40 years of investing experience. It's a free event, but you do need to register. Just go to WallStreetZen.com/live or click the link in the description or scan the QR code on your screen. Just pause the video for a moment. I'll wait for you. Go ahead, sign up, and then I look forward to seeing you on on Monday. Back to that last pick. Here's something you rarely see. A company growing its revenue by nearly 20% a year, earnings growing 40% a year, and yet trading for a shockingly low 4 PE under 5. We're talking about Collegium Pharmaceutical, the symbol is COLL, which is a specialty pharma company focused on treatments for pain and more recently expanding into the large ADHD market. Now, like I shared before, revenue is expected to grow robust 20% a year, but it's that 40% earnings growth that really should have your attention. That's much higher than industry peers and much higher than the broader market. Even with all that growth, the value story comes into full focus as investors are not properly paying for this ample growth. That shows up in the rock bottom PEG ratio of 0.34. Again, 1.5 is the average PEG. Collegium would need to rise fourfold to reach that level. One reason it's still cheap is a bit of an old story. Collegium is known as a pain medicine company, and pain pharma is a corner of the market investors treat with suspicion, worried about regulation, pricing, and legal overhang. So the whole company gets painted with that brush, but that story is way out of date. A couple years ago, Collegium acquired a company called Ironwood. This got them into the large and growing ADHD market with a drug called Journey PM. That is their main growth engine, and its patent exclusivity runs into the next decade. The market is still pricing shares based upon the pain side of the equation. That antiquated view is what spells opportunity for us deep value seekers. Wall Street analysts covering Collegium are unanimously bullish. Beyond the buy recommendations are fair value price targets, suggesting hefty upside potential ahead. The most bullish voice on the stock is Serge Bollinger of Needham, who sits in the top 2% of all analysts tracked based upon his actual stock picking prowess. He is pounding the table for greater than 70% upside potential in the year ahead. Now, when an analyst that far up the performance leaderboard is still calling for that kind of upside, it is worth strong consideration. Now, turning to our Zen ratings model, it'll be a shock to no one when I say we have another elite A-rated stock. In Collegium's case, it's gleaming fundamentals placed in the top 3% of all stocks tracked. The component grades show several areas of strength, right? We're talking about financials in the top 2% of all stocks. The AI grade is right there too, the top 2%. And as I shared before, that is our model using AI to detect the kind of pattern that tends to lead to shares that outperform in the months ahead. Now, best of all is that the stock is in the top 1% for value here. Again, we're talking about deep value stocks today. The risk is that they still have a large pain pharma business, and that segment always carries some regulatory and pricing uncertainty. But as the ADHD growth story unfolds, it increases the odds that investors rush to this value stock to bid it up much, much higher. Yet another compelling opportunity potentially worth a spot in your portfolio. So there you have it. 4 deep value stocks worth exploring right now. Every one of them came straight out of the data on WallStreetZen.com. Just remember that the Zen ratings are updated daily, and you can pull a full rating on over 4,600 stocks yourself just by typing in the ticker at WallStreetZen.com. So do yourself a favor and bookmark the site for frequent future visits. Now I want to hear from you. Which of these 4 stocks is your favorite? And is there a deep value stock you think I missed? Drop it in the comment section below for the benefit of our community. Now, if you're not sure what to watch next, then check out the video that's popping up at your screen right now. In that one, I reveal my 15 buy and hold forever stocks.